All right, so this next little section, we're going to talk about something called purchase discounts. And it says here on our slide, it says to encourage buyers to pay before the end of the credit period, the seller may offer a purchase discount. Okay, so let's unpack this sentence here. So let's say that we had the example for the merchandising business back at the very beginning of the chapter. We talked about the steps in the process, and we said that we were going to obtain inventory, and we were either going to pay cash for it or we were going to set up an accounts payable. And so what we're talking about is, when we talk about the buyer, we're talking about, and for purposes of our discussion, the buyer of inventory that is purchasing this inventory on credit. Okay. So this encouragement comes in the way of a purchase discount. We buy inventory. We'll have an example on the next page, but it says, for example, a seller may offer a 2% discount if the buyer pays within 10 days of the invoice date. Okay. If the buyer does not take the discount, the total invoice amount is due within 30 days. Okay, so this is our example. And it says that the terms of such an example are expressed as 2/10, n/30. And that's not a real complicated math formula or anything. It says, and are read as, you get a 2% discount if you pay within 10 days, and the net amount, that's the N here, is due within 30 days. Okay. Now you may not think that a 2% discount is a lot, but you can't think of this as 2% interest over, say, 365 days, because look, this is only over a 10-day period. So let's look at what happens. I don't want to bore you with all the math here, but what we have is an example of what we call implicit interest. Okay, and so if we do not take the discount, we say, okay, with the previous example, if we take the 30 days when the bill is due and we subtract 10 from that, that's the discount period, we come up with 20. If we use a 360-day year, just for purposes of simplicity really, and we divide by 20, which is the difference between the discount period and the net period time that we have to pay the bill by, we come up with 18. Okay, so if we move down here and we take 2% and we divide by the remaining 98%, that's 100% minus the 2% discount, we get this decimal of a little bit over 2%. But we have to understand that this spread here, this 20 days, will go into our 360 days 18 times. So we get down here and we multiply 18 by the 2% here, and we come up with an effective annualized interest rate of 36.72%. So you are going to need to be able to do some basic calculations regarding discounts. But what this slide, really the purpose of this slide, is just to show you that if you're offered a 2% discount within a 10-day period with net 30 terms here, and you don't take it, you are effectively paying 36.7% interest. So to give you an example, credit cards routinely charge something like 18% interest. Okay, so this is more than this figure here is more than double that. So if we have the money and we have a retail business and we're offered a discount like this, we definitely want to take it, because by not taking it, we're paying interest. We're essentially borrowing money from the person we bought the merchandise from and paying it back at a very, very high interest rate. Okay? So that's why in this class we are always going to assume, when we have a transaction where there's a discount offered, we will always assume that the discount is taken. Let me say it again. we will always assume that the discount is taken. If you see a question and there's something about a percentage discount, something like this right here, the 210 net 30, you are to assume that the discount will be taken, because to do otherwise would be foolish. Okay? All right, so here's an example, journal entry example. It says, since buyers normally take all purchase discounts, inventory is debited for the net purchase price under the perpetual inventory system. So let's say that we get an invoice in the mail, and the invoice is for $10,000. Yes. With terms of 210 net 30, we do not record that merchandise at $10,000. Okay, we're going to record that merchandise inventory at $9,800. How did I come up with that? Well, if we take the 2% discount, 98% of 10,000 is 9,800. So we're going to debit inventory, our asset account, on May the 5th, and we're going to credit accounts payable, subsidiary account, Alpha Technologies, for the same 9,800, because this is all we're going to pay them. We're not going to pay them 10,000. And then we have a journal entry explanation. To record inventory on account means we have to pay for it still, net of discount. Then, fast forward 10 days, we're going to write a check or get online and pay. We're going to debit that accounts payable to Alpha Technologies for the same 9,800, and we're going to credit cash to record payment of Alpha account payable for cash. Okay, so that's easy enough to understand. As we get into this a little bit, we're going to have some examples that can get a little bit tricky. Purchase discounts is one of the more difficult concepts that we'll cover in this chapter. So if you can get purchase discounts down, you can get everything else down. All right, let's see what else we have. Oh, yeah, this is where it starts getting a little bit hairy, so to speak. So keeping in mind that we take purchase discounts, we also have to assume that from time to time we're going to have purchase returns and allowances. It says a buyer may request an allowance for merchandise that is returned, or a price allowance, purchases allowance, for damaged or defective merchandise. Okay, it says from a buyer's perspective, this is the buyer that purchased the inventory, such returns and allowances are called purchase returns and allowances. Okay, so we've got inventory, then we bought it at a discount, then we're going to return maybe part of it. Yeah. So we've got some stuff to keep track of. Debit memos. It says here, a debit memo informs the seller of the amount the buyer proposes to debit to the account payable. Remember, when we set up an account payable, we're setting it up with a credit. So if we issue a debit memo, what we're essentially saying to the seller is that, okay, you know, we set up an account payable for $9,800, but $500 of this merchandise is the wrong thing, and we don't want it. So instead of paying you $9,800, we're going to maybe pay you $9,300 in cash, and then we're going to issue a debit memo for the remaining part of that. Okay, and that's going to satisfy our obligation to you. You're going to get $9,300 and the incorrect merchandise back, and we're going to keep $9,300, and we're going to clear out the $9,800 that we owe you. So that's what a debit memo is. We have an example here. This is from our good buddy Net Solutions. Okay, and looks like they, in this particular account, remember, this is a document from the buyer to the seller. So I want you to understand that in this example, Net Solutions is the original buyer, And we said that Net Solutions was probably a service company, but service companies can still buy supplies and stuff like that. So the seller of whatever this is called Maxim Systems, okay? And it says, we debited your account as follows, all right? 10, a quantity of 10 server network interface cards from the invoice 7291 are being returned. And that's because you sent us the wrong thing, okay? We don't know what they received, but this is what they ordered, and that evidently that's not what they got. So 10 at $90 a piece is $900. So we don't have the information in terms of what this account payable was, but we know that whatever it was, Net Solutions is going to return this merchandise, and this $900 is $900 that Maxim Systems is never going to get. Okay, this is a debit memo. So a debit memo is issued by the buyer of the inventory or supplies. Okay, so they had originally put this inventory into their system, and now they've realized, okay, wait a minute, this is not what we ordered. So how do we take care of this? How do we get this inventory out of our system? How do we avoid overpaying? Well, here's our journal entry. We're going to debit accounts payable, subsidiary account Maxim Systems, for the $900. This part of the journal entry would be the same if they were paying cash for this inventory. But that's not what's happening here. We're not paying cash, we're returning it. So now we're going to credit the inventory because it's going down. Inventory is going down. Okay? So what this does is this satisfies $900 of our accounts payable obligation, and it gets $900 worth of incorrect inventory out of our system. Okay? All right, I think what we're going to do is we're going to stop this video and we're going to move into some new material in the next one.